Your revenue number is lying to you every single month. And if you keep believing that lie, you're going to stay broke no matter how busy you get. I'm Wade Carpenter, CPA for contractors, and today we're talking about real revenue, what you can actually spend to run your business after you strip out every dollar that was never yours to begin with. Most of you think $1 million revenue month means you got $1 million to operate on. That's like thinking the concrete delivery truck is part of your tool inventory. The money was never yours. It belonged to your subs, your suppliers, and the permit office before it even hit your account. Let's fix that thinking right now. If you're a commercial GC or a trade contractor and you've ever wondered why you're always cash tight, despite good revenue, this is your answer. You're counting money that's already spoken for. Standard profit first tells you subtract materials and subs from revenue. That's a start, but it's like using a finished hammer for demo work, not built for construction reality. PFCC takes it further. We filter out every job-specific cost. Materials, subs, permits, bonds, equipment rentals, job-hired labor, even job-tied payroll taxes. What's left is your real revenue, the actual foundation you can build your business on.
Without this clarity, you're building on quicksand. You underbid because you don't know your true costs. You overspend on overhead because you think you can afford it. And you shortchange profit, your own paycheck, and taxes because you assume there's more money coming than there really is.
Here's what most contractors do. They look at a $500,000 job, see $500,000 in revenue, and think, hot damn, we're flush. But $300,000 of that is going straight back out for materials and subs. Another $20K for permits and bonds, another $30K for that crane rental you need for 3 weeks. So you didn't really bring in $500,000. You brought in $150,000 to run the company. That's a 30% gross cash margin, not the 50% you thought you had.
This overstatement is the crack in your foundation that brings the whole business down. It's not just an accounting quirk. It's the reason you're always scrambling to make payroll, always dipping into the line of credit, always wondering where the hell the money went. The original Profit First tried to address this by saying subtract materials and subs. But construction has more hidden pass-throughs than a small town has gossip. Permits, bonds, job-specific rentals, job-hired labor, all of that behaves the same way. It's pass-through cash.
So let me give you the PFCC definition of real revenue. Plain and simple. Real revenue equals revenue minus JobEx. JobEx is any cash outflow that exists only because a specific job exists. No job, no outflow. That's the test.
Let me walk you through what counts as JobEx, because this is where most contractors trip over their own bootstraps. Direct job costs, subcontractors, materials, the obvious stuff. Even your cousin's boy who barely graduated high school can figure that out. Job-specific permits and bonds, that $5K permit for the hospital edition, that performance bond for the school project, those dollars are married to those jobs tighter than bark on a tree. Job-specific equipment rentals, the crane you rent for 3 weeks, or the specialized lift for one project. But here's the kicker. If you own the equipment and you're making payments, those belong in OpEx. It's about cash behavior, not ownership paperwork. Field labor hired job by job, W-2 installers, or crews you staff up only when work demands it. If you lay them off during a slow month, their wages belong in JobEx. But if you carry a crew, even when the backlog's thinner than soup at a homeless shelter, those wages behave like OpEx. Job-tied labor burden, the employer payroll taxes, and benefits that scale directly with job hours. But baseline benefits you pay regardless, like your core crew's health insurance, stay in OpEx. Job-dedicated shop fabrication. When your shop produces something for a specific project, those materials and labor hours belong in JobEx. General shop overhead stays in OpEx where it belongs. Job-specific consultants. That permit expediter you hired for one project? JobEx. Your standing relationship with the entitlements guy? OpEx. The pattern is clear as glass. If it's project-specific, it's pass-through.
Let me show you what this looks like in real numbers. Say you're running a typical month. Total revenue collected, $1 million.
JobEx outflows. Subcontractors, $450,000. Materials, $180,000. Job-specific permits and bonds, $15,000. Equipment rentals, $25,000. Job-hired field labor, $25,000. Total JobEx, $695,000. Your real revenue is $305,000. That's it. That's what you have to fund overhead, your paycheck, profit, and taxes. Your gross cash margin is 30.5%, not whatever inflated number you were using before. Now let's keep going. Say your cash adjusted OpEx for the month is $220,000. That includes rent, insurance, permanent crew wages, owned equipment payments, office staff, marketing, all the stuff that sticks around whether you have work or not. Residual revenue equals real revenue minus OpEx. Residual revenue equals 3 on 5,000 minus 220,000 equals 85,000. That 85K is your profit, owner's compensation, and tax fund. That's the pot of gold that makes ownership worthwhile. Now, if your target is 10% of total revenue for POT, that's 100K. You're 15K short this month. You've got 3 choices: raise prices, lower OpEx, or reclassify some costs from OpEx to JobEx if they're truly job tied.
Here's where PFCC gets serious about protecting your real revenue. You need a separate bank account dedicated exclusively to JobEx outflows. Every subcontractor payment, material purchase, permit fee, equipment rental, and job-tied payroll flows through this account. Nothing else.
This physical separation keeps job cash from being stolen by overhead needs. When your office manager needs to pay rent and the JobEx account has 50K sitting in it, she can't touch it. That money belongs to the electrician and the concrete supplier, not to your rent. Without this separation, job costs and overhead fight like dogs over a bone. And guess who loses? Either you, your trades, or both. With the separation, your subcontractors get paid on time, every time. Your reputation strengthens, your relationships improve, and you can see your true gross cash margin every single month without playing accounting games.
Here's the tactical move that'll change your business. Use residual revenue as a bid guardrail. Before you submit any bid, model your expected JobEx and OpEx. Calculate what residual revenue you'll have left. If it doesn't hit your target percentage of, say, 10% of total revenue, don't bid it or raise the price. This isn't about perfection. It's about discipline. It's about knowing your numbers before you sign the contract, not after the money's gone.
Track your gross cash margin every month. Revenue minus JobEx divided by revenue. If GCM drops, investigate. Are you taking on heavier pass-through jobs? Is cost control slipping? Track your residual revenue percentage every month too. If it misses your target, diagnose the problem. Are your bids too thin? Is OpEx bloated? Is JobEx being misclassified? Your target allocation percentages must reflect your reality, not some generic template. A contractor who rents everything and hires job by job might have 70% JobEx. A self-performing contractor with owned equipment might have 45% JobEx and 35% OpEx. Neither is wrong, but both need to know their number.
Let me save you some pain. Here are the 4 ways contractors screw this up.
1. Ignoring small, job-specific items like permits, bonds, or short-term rentals. These add up faster than you think and inflate your real revenue if you're not careful. 2. Paying JobEx from your OpEx account instead of the dedicated JobEx account. This hides true job cash demand and starves your overhead or owner funding later. 3. Copying generic taps without adjusting for your trade's reality. A plumbing contractor's cost structure looks nothing like a GC's. Yours probably doesn't either. 4. Using P&L OpEx without cash adjustments. Equipment note payments are real cash going out. Depreciation isn't. Adjust for actual cash behavior, or your residual revenue will lie to you just like your total revenue did.
So here's the bottom line. Real revenue is the cash you can truly operate on after every job-specific dollar has been filtered into JobEx. It's an expanded construction-aware pass-through lens that powers clearer margins, safer allocations, steadier trade partner payments, and smarter bidding. Stop lying to yourself about what money is actually yours. Filter out what belongs to the jobs. See what's left to run your business and price accordingly. When you know your real revenue, you build on solid ground. When you don't, you're gambling with every bid and hoping the foundation holds. If you want the full system, JobEx, OpEx, real revenue, residual revenue, taps, and the whole bank account structure, grab the book, Profit First for Commercial Construction on Amazon. It's the blueprint for construction cash flow that actually works. And if you want help implementing this in your business, audit your chart of accounts, set up your JobEx account, calculate the true cash margin, head over to ProfitFirstConstruction.com and schedule a call with our team. We specialize in this, and we speak contractor. Subscribe to this channel if you want more straight talk on construction cash. No fluff, no theory, just what works. Thanks for watching. Now go figure out your real revenue and stop building on quicksand.